Maxing out a Roth IRA is the simplest way for the average American to build wealth and eventually become a tax-free millionaire. Yet less than 40% of Americans actually have a Roth IRA. If you were to start today and invest $540 per month for 40 years, assuming 7% annualized returns, you would have about $1.2 million of tax-free income if that money was in a Roth IRA. In fact, this account is so powerful that if you make over a certain income threshold, the government says that you are not allowed to just make direct contributions into a Roth IRA anymore. If this is your situation, what you have to do is the backdoor Roth IRA. This would require you to open up both a traditional and a Roth IRA account. Essentially, you're going to have to fund the traditional IRA first, and you're going to have to let that money sit there and marinate, and then after a few weeks, you can then convert that money from a traditional IRA over to a Roth IRA. And then during tax season, you will need to file Form 8606 to keep track of your basis in your Roth IRA. This is very, very important. You will have to file Form 8606 every single year after that to report what your basis is in your IRA. Now, one thing you do want to keep in mind whenever you are going to do the backdoor Roth is the pro rata rule. The pro rata rule states that when you convert a traditional IRA to a Roth IRA, you will be taxed on the proportion of pre-tax dollars to post-tax dollars in all IRA accounts. What exactly does this even mean? When you put money into a traditional IRA, generally, if you are not over the income threshold, you get a tax deduction for putting that money in there. Those are pre-tax dollars. Whenever you put money into a Roth IRA, you do not get a tax deduction, so you have post-tax money. The pro rata rule looks at the proportion of pre-tax and post-tax dollars in all IRA accounts. So if you have a SEP IRA and you have made a contribution to your SEP, so let's look at an example. Last year, you put $3,500 into a traditional IRA and you took a tax deduction. So you have $3,500 of pre-tax money. This year, you want to do the backdoor option, but you're over the income threshold. So you're going to make a non-deductible contribution of $6,500 to your traditional IRA, and then you plan to convert the full $6,500 over to your Roth IRA. However, you now have $3,500 of pre-tax money and $6,500 of post-tax money for a total account balance of $10,000. Whenever you convert the $6,500 over to your Roth, you have to go back and you look. 35% of your account is pre-tax money. So 35% of your conversion of that $6,500 will have to be added back as taxable income. So in this example, when you convert the full $6,500 over to your Roth, $2,275 of that $6,500 will be considered taxable income. This is very, very important, and you must pay attention to this because for self-employed individuals who have a SEP IRA and maybe they put in $50,000 or $100,000 over the years, if they try to do a strategy like the backdoor Roth, they may accidentally make most of their contribution into actual taxable income. Speak with a tax advisor and make sure that you are not accidentally falling into the pro rata rule trap whenever doing a strategy like this.